Hello everyone, I hope you're all doing well wherever you are in the world. My name is Musa and welcome back to Redemption Trading's Frequently Asked Questions series. In part 1, we laid a very good foundation with most common beginner questions. In this next set, we are going to build on that knowledge. The goal is to clear any gray areas before you embark on your journey as a beginner, because like I promised, we are not going to leave anyone behind. So let's do that and clear all the uncertainty, all the fear and all the doubt, so that we start with confidence and achieve our goals as successful traders. Let's get straight into that. Before we dive into it, please note, everything said on this channel is meant for education and entertainment purposes only. Nothing said on this channel should be taken as personal financial advice. Now, if you are new to this channel, would you please subscribe, hit that notification button, like the video and share it with your family and friends. Right. The next two questions are closely interrelated, and so I'm going to try and answer them with one shot. Okay, the first one is, what is the difference between spot trading and futures trading? Right, and then the second question is, how do people in trading make huge profits from very small amounts of capital? And on that same note, how do people in trading blow their accounts within a short space of time? Okay, so I'm going to try and run through these questions as quickly as possible so that we can cover as much ground as we can in this short space of time. Right, so with spot trading, you buy an asset and that asset belongs to you. For example, you buy Bitcoin at $100,000 a coin. That Bitcoin belongs to you. You can sell it whenever you want, after a week, after a few months, after 5 years. It's all up to you. It belongs to you. Now, when the price of Bitcoin goes up, say by 10%, you have made a profit of 10% of $100,000. You can sell or you can keep holding, anticipating further rises in price. And on the other hand, if the price of Bitcoin falls below 100,000, it means the value of your Bitcoin will drop with that percentage loss in value. Meaning that if Bitcoin drops in price by 10%, it means now the value of your Bitcoin is now $90,000. Now, most traders know that it's a game of waiting. If the price drops again, say to 80, hardcore OG traders will still hold because they know that at one point it's going to go back up again and they will be in profit. So that's basically what spot trading is. You buy an asset and you hold it, and then you sell when you realize your target profit or whenever you want to get out of that trade. Futures trading is a completely different ball game altogether, and it's not something that I would recommend to someone who's starting off. It's a bit more complicated and requires a lot of experience. So in this case, you are not simply buying an asset and holding it like you did with spot. With futures, you are actually speculating on the price movement of an asset. For example, if you think that the price of Bitcoin is going to go up, you borrow funds from the exchange and you buy Bitcoin and hold it for a certain amount of time, and then sell when the price goes up and you realize a profit. So you keep the profit and give back the borrowed funds to the exchange. Same thing applies if you think that the price of Bitcoin is going to drop. So you borrow funds, you buy the Bitcoin, and then you sell it, anticipating a further drop. If it drops to your certain level, your projected level, you then use those funds that you sold your Bitcoin to buy it back at a cheaper price. Then you keep the difference. You understand? So this is actually called it's referred to as contract for difference, CFDs. So basically that's what futures is all about, and spot trading is the simpler version that I would advise beginner traders to start with. And then as you build confidence, as you build experience, you can slowly move on to leverage, which is more fun. Now you will notice that the answer to the first question partly answers the second question as well. These crazy amounts of profits and huge losses in trading are made in futures trading, not much in spot. Spot is a safer way of trading. So what happens is with futures trading or with leverage trading, you are able to control a much bigger position than the amount of money that you have in your trading account. I'll give you an example. Say you have $10 US in your trading account, and you want to go long. You think the price of Bitcoin is going to go up. So you borrow 10 times the amount that you have from the exchange. That is called a 10x leverage, which means you can now control a position of $100, right? If the price of Bitcoin goes up by 10%, it means you have made 10% of $100, which is $10, right? If you sell at that 10%, you've just doubled your initial capital. That's where it all comes from. Imagine if your initial capital was 1,000 or 10,000. You're doubling it within a short space of time. But the same thing happens if the price goes against your prediction. You make losses as faster as you make your profits. So in our example, if you have $10 and the price of Bitcoin falls below by 10%, it means you now have $90, isn't it? Because when you borrowed, it was 10x, it went to $100. Now if Bitcoin falls by 10%, you are now sitting at a value of $90. Now that's a loss of $10. All right. Do you see where we're going now? That loss of $10 actually wipes out your initial capital. Because remember, you only had $10 with you, and then you multiply it by 10. So that's where all these crazy gains and crazy losses come from. Now, the next question is very pivotal to trading in general. It relates to all those signs, icons, and tools that you see on the charts. Those are called indicators. So beginners always asking, what are those indicators and what role do they play? How do we use them? Okay, so I personally keep it simple. There are thousands of indicators out there, but for you to be consistent and for you to be successful in trading, you do not necessarily need to know all of them and use all of them. You just select a few that you are good at, and then you stick to those. In my case, I use about 4 to 5 indicators when I'm analyzing my charts. So the main ones that I use, the Fibonacci retracement tool. This one I use it to identify possible bounce areas of prices when they move either up or down. Because remember, prices of assets are always moving up and down. So maybe you want to enter into a trade, but the price has gone up already. So you don't just jump in when the price is going up. You actually wait for it to pull back. So the Fibonacci is a tool that you can use to identify those areas where prices normally pull back to. You know, those are called pullback zones or reset zones. Okay, so that's the Fibonacci. And then the other ones that I use the moving averages. Moving averages tell me where the general direction of the market is going, whether it's an uptrend or a downtrend. And I also use the RSI. The RSI is the relative strength index of price. You know, this one shows me, it tells me a story about an asset. Every time when you look at a chart, you should be able to tell a story about a certain asset. So the RSI tells me whether an asset has been overbought, which is at the top, or whether the asset has been oversold, which is at the bottom. So it's like an oscillator which goes up and down. So it tells you now, if you want to buy, normally you don't want to buy at the top when it's overbought. You see? That's when you should be selling. You want to buy at the bottom when it's oversold. These you will understand as we progress. But for now, I just want you to have a feel of what they mean. I also use volume. You know, volume, I use it to confirm whether an uptrend is real, it's solid. You know, if you want to enter into a trade, you need to confirm it. Is it backed up by enough volume to sustain an uptrend? You know, and what else do I use? Okay, basically that's about it. And then a few more here and there, you know, like your trend lines and stuff like that, to draw joining either the highest points of a trend or the lowest points of a trade, etc. That's about it for indicators. So these ones, they help you to identify areas of entry or areas of exit. Very, very crucial to a trader to understand how indicators work. All right, the next question is very fascinating. Is trading not the same as gambling? What is the difference? Well, trading will look like gambling if you do it without a plan, if you do it without risk management. You understand? Proper trading is based on analysis. It's based on strategies that have been back tested, and it's based on discipline, how to control your emotions and stuff. Whilst on the other side, gambling is based purely on luck, which is like 50-50. If you put a bet, it's either you're going to lose or you're going to win. You do not have control of the position. That's the main difference. We take risks in trading, but well calculated risks. That wraps up our session on frequently asked questions. I hope it brings light and that it clears the way for a much smoother learning process. Thank you so much for hanging out with me. I hope to see you in the next one. Take care.